As discussed in the previous chapter, accounting is concerned with the recording, classifying, and summarizing of financial transactions and events and interpreting the results thereof. It aims at providing information about the financial performance of a firm to its various users such as owners, managers, employees, investors, creditors, suppliers of goods and services, and tax authorities, and help them in taking important decisions. The investors, for example, may be interested in knowing the extent of profit or loss earned by the firm during a given period and compare it with the performance of other similar enterprises. The suppliers of credit, say a banker, may in addition be interested in liquidity position of the enterprise. All these people look forward to accounting for appropriate, useful and reliable information. For making the accounting information meaningful to its internal and external users, it is important that such information is reliable as well as comparable. The comparability of information is required both to make inter-firm comparisons, that is to see how a firm has performed as compared to the other firms, as well as to make inter-period comparisons, that is how it has performed as compared to the previous years. This becomes possible only if the information provided by the financial statements is based on consistent accounting policies, principles and practices. Such as consistency is required throughout the process of identifying the events and transactions to be accounted for, measuring them, communicating them in the book of accounts, summarizing the results thereof, and reporting them to the interested parties. This calls for developing a proper theory base of accounting. The importance of accounting theory need not be overemphasized, as no discipline can develop without a sound theoretical base. The theory base of accounting consists of principles, concepts, rules, and guidelines developed over a period of time to bring uniformity and consistency to the process of accounting and enhance its utility to different users of accounting information. Apart from these, the Institute of Chartered Accountants of India (ICAI), which is the regulatory body for standardization of accounting policies in the country, has issued accounting standards which are expected to be uniformly adhered to in order to bring consistency in the accounting practices. These are discussed in the sections to follow. 2.1 Generally Accepted Accounting Principles GAAP. In order to maintain uniformity and consistency in accounting records, certain rules or principles have been developed which are generally accepted by the accounting profession. These rules are called by different names such as principles, concepts, conventions, postulates, assumptions, and modifying principles. The term principle has been defined by AICPA as a general law or rule adopted or professed as a guide to action, a settled ground or basis of conduct or practice. The word generally means in a general manner, that is pertaining to many people, persons or cases or occasions. Thus, generally accepted accounting principles GAAP refers to the rules or guidelines adopted for recording and reporting of business transactions in order to bring uniformity in the preparation and the presentation of financial statements. For example, one of the important rules is to record all transactions on the basis of historical cost, which is verifiable from the documents such as cash receipt for the money paid. This brings in objectivity in the process of recording and makes the accounting statements more acceptable to various users. The generally accepted accounting principles have evolved over a long period of time on the basis of past experiences, usages, or customs. Statements by individuals and professional bodies and regulations by government agencies and have general acceptability among most accounting professionals. However, the principles of accounting are not static in nature. These are constantly influenced by changes in the legal, social, and economic environment as well as the needs of the users. These principles are also referred as concepts and conventions. The term concept refers to the necessary assumptions and ideas which are fundamental to accounting practice, and the term convention connotes customs or traditions as a guide to the preparation of accounting statements. In practice, the same rules or guidelines have been described by one author as a concept, by another as a postulate, and still by another as convention. This at times becomes confusing to the learners. Instead of going into the semantics of these terms, it is important to concentrate on the practicability of their uses. From the viewpoint, it is observed that the various terms such as principles, postulates, conventions, modifying principles, assumptions, etc., have been used interchangeably and are referred to as basic accounting concepts in the present chapter.